Good afternoon, everybody. Thank you for joining us on a Friday, which is a little bit unusual for us to do an investment update. I think this has been quite an unusual week and continues to be somewhat unusual in the US election as we're continuing to wait for confirmation coming out. This kind of added an additional challenge to us in trying to make sure that some of the information that we're presenting to you is as up to date and accurate as we can possibly make it. So we thought we'd try and give ourselves a little bit more time in the hopes that we would have some sort of clarity of a result by now, but it looks like it's still going to be dragging on for another day or two at least. Thank you for joining us. We've got our usual sort of group of individuals from the investment management team. We're going to be talking about their areas of specialism and expertise. I think we're going to be drawing on a lot of this in the rest of 2020 and especially as we head on to 2021 and continue to try and navigate the markets there. Agenda for today, as usual, in terms of looking at some of our model performance, the macro environment, glimpse into what we have been seeing in the US election, and then sort of diving into the worlds of fixed income and equities. And we have added on an interesting new aspect for this one, which is going to be looking at some developments in the ESG space and how things are looking in that regards. So if we skip straight on to performance, there's obviously a couple of different aspects here. One, we've had some, finally, a little bit of pullback in the markets from a risk asset perspective, which have looked a little frothy or overvalued in recent months. We've continued to adjust some of our holdings, allocations, and we've made a couple of changes in both September and October. We have obviously seen equity markets sell off a little bit. On the treasury side, we've seen some of those yields move higher, which has also impacted some of our more conservative portfolios. But the good news is that for most of our models, we remain ahead of our absolute return targets and remain comfortably ahead of our peer group. So we have a little look at October performance. On the right-hand side, as I said, pretty much across the board, all negative. Gold just sort of slipping down towards the end of the month. And we have seen yields moving higher. So 10-year US yields are giving us a heady 86 basis points. What that's meant from our perspective when we're looking at the monthly multi-asset models, although we were negative and dollar balanced, which is the one that we most frequently talk about, was down 100 basis points versus the monthly target return of 32 basis points. We were in line with our peer group from a private client perspective, and this is with our higher weighting to US Treasuries, longer dated US Treasuries, and that move in yield has hit through negatively from our perspective when we're looking at performance. On the sterling perspective, we've had some different impacts because we're not holding the US Treasuries, so our performance is better than our peer group. But if we look on a year-to-date basis, what that has resulted in is all 9 of our global multi-asset models remaining in positive territory year-to-date, despite the little setback that we have seen in October. We're looking at this both from the absolute target return as well as in comparison to our peer group. We are, as we can see on the right-hand side with the S&P, only sitting a little bit in positive territory on a year-to-date basis as at the end of October. We've been having a lot of conversations internally, as you can imagine, when we're looking at asset allocation, and we are debating about, is now the right time to be moving into risk assets. So when we are starting to look at the numbers in comparison to our peer group, we remain much more conservatively positioned, and we have a much lower allocation to equities across all 3 of those different risk profiles. If we jump on to finally, before I can kind of pass on to James, when we're looking at the difference between September and October, you can see that we increased our exposure to global equities over the course of the month. We will go into a little bit of detail about that. It just feels funny talking about some decisions that we made in October, given that we've had so much happening over the course of the last week or so. But that's been primarily done through purchasing a number of ETFs to give us some specific exposure in different parts of the world. On the satellite perspective, single stocks, we've made a couple of little tweaks and rotations and allocations over the last month or so, but we haven't really made any particular new investment decisions in that regards. And then as you can see, our cash balance given where yields are both at the shorter end of the government curve and what we can get on cash. We've taken that down as low as we possibly can at 70 basis points in the model, and have maintained the rest of our allocations, but brought a little bit more into the longer end of the US curve. If there are any questions on performance allocations, I'm happy to take them now. But what I would suggest is that we pass across to James, who's going to talk you through some of the macro highlights and thoughts from his perspective. And then as we move on to fixed income and equities, if there are any questions that people have, please feel free to put them in the Q&A box at the bottom, and we can either pick them up at the end of sections or we will come back to them at the end. But for now, I will ask James to come in and take center stage.
Great. Thank you, Simon. It's been an interesting month. Quite a bit has happened. So lockdowns have returned in Europe, and I'm going to spend a little time talking about that. I think it's probably not going to be anywhere near as significant as it was in the spring. It's still going to hurt, but it's just not going to hurt as bad. And then I'd like to talk a little bit about how this recovery is unfolding around the world. You might recall that at the beginning of the year, there was this sort of endless debate as to what letter of the alphabet this was going to be. Was it going to be a V or a U or an L or a W, or even a Nike swoosh shape? But now it looks very much like a K. And so that's gonna have a real big impact in the investment strategies that we pursue and recommend. And then finally, something which has been taking quite a lot of my attention over the course of the past week is the US election, which is unfolding literally as we speak, even though the voting was several days ago. And that's really quite a dramatic set of events. So diving right in. So Europe, as I mentioned, re-entered lockdown this month. And on the left-hand side of this chart, what you see is an effective lockdown index that I've borrowed from Goldman Sachs. And what this does is it collects a lot of different data sources and shows you the actual impact of the policies that are pursued by governments on the actual activity within the economy and the society. So what you can see is that China, not surprisingly, went first and went hardest in the spring, and then since then has steadily continued to unlock, reopen, and at this point is, broadly speaking, somewhat restricted, but not very tight. The Europeans went next, not quite as deep as the Chinese, but for a bit longer. And you can see that they're starting to now tighten up again. And then finally in the US, the lockdown was actually more shallow and more brief, and hasn't really persisted, quite to the same level. And then you can see how that shows up in economic activity. Now, on the right-hand side, I'm using a GDP proxy, which is also borrowed from Goldman Sachs. And this is a nice way of giving us a very real-time, a nowcast, as we call it, of what the pace of GDP growth is in these different countries. And there's something really extraordinary. The Chinese obviously saw a really sharp decline early, but there was a really swift rebound. And then subsequently, the Chinese have maintained a steady pace of growth, whilst the Europeans and to an extent the Americans have had a much more, have had a much deeper decline, a less impressive rebound, and a more sluggish recovery since. And the reason why I'm going through this is because I want to try and illustrate that the spring lockdown that we saw was really extremely severe, and that it had a really dramatic impact on the pace of economic activity. But I don't think that the lockdown is going to have quite the same level of impact this time around. In other words, I think it's going to be more targeted, and I think people are probably better prepared. So the end result is going to be a more shallow dip in this effective lockdown index and a more shallow dip in the pace of activity. It's still going to hurt, it's not going to hurt quite as much. Now, one of the most immediate sort of responses we saw with the lockdown was a dramatic sell-off in Brent. So Brent fell off by about 10% over the course of a few days in short order, and I think that's probably an overreaction. I think that the crude oil market, is going to be moving into a deficit next year as supply cuts start to really catch down with the decline in demand. So what we've seen over the course of the past few months is that producers in the US, particularly in the shale patch, have been able to hold off on dramatically reducing capacity, thanks in part to cheap money. Well, they're running out of rope. Then with this lockdown announcement out of Europe, there was sort of a scaling back of expectations on travel, and thus travel-related fuel demand, which I think is probably overstated. Having seen that sell-off, I think markets are now starting to recognize that actually looking forward over the course of the next 12 months, we're probably moving into a period where demand gently recovers, even with the lockdowns that we've seen, but that supply really doesn't recover as quickly. And that pushes us into a deficit, which I show you on the right-hand chart as the blue shaded areas. That means that demand is in excess of supply, and deficits point to backwardations. On the left-hand slide, that would be the blue shaded area where the front end of the Brent curve is above the back end, and to rising prices. So that's what I'm looking for next year. And this is an example of how I think that the markets have probably overreacted, initially at least, to the announcement of the lockdown in Europe. It's not to say it's not going to be a difficult situation, but it's probably not going to have anywhere near the kind of ramifications that we had earlier this year. Now, if we think about how this recovery is unfolding around the world, I sort of see three different parts to what this K-shaped recovery. And by K-shaped, I mean that some people are doing, or some sectors or some places are doing a bit better, and some people are doing quite a bit worse. So what I've done here is I have taken that same current activity index that we borrowed from Goldman Sachs, and have and converted that into a level. So basically, what this shows you is the pace of activity, the level of activity, rather than the change. And so what we can see is that in China there was a pretty steady, steep decline. So you know, we saw the Chinese market slow down, but at the moment we're actually above the pre-lockdown peak. China is currently at about 2.8%. The Chinese economy has expanded about 2.8% above the pre-lockdown trend. And it's only about 2.5% below where we would expect the trend. So there's that line which kind of sticks out from the edge. Just sort of imagine that is an extrapolation of the trend that would have been in place using the 10-year cumulative annual growth rate of 7.5% for China. So China's almost back to normal. The Chinese economy has really substantially recovered. Compare that to Europe. Now, Europe has had a much slower pace of growth over the past 10 years, only about 1.3%. And it is currently down quite a bit. It's down about almost 8% from the trend pace, and about 7.3% from the pre-lockdown peak. But that's actually better than the US. So the US has had, in some respects, a worse kind of outcome. So the US is around 10% below the pre-lockdown peak, about 11.5% below trend. That's because the US fell more sharply. So what you see is a real differentiation between sort of global economic winners, so to speak, with China being the sort of the standout, and the losers, with surprisingly the U.S. still having a lot of room to pick up. There's another aspect to what I call this K-shaped recovery. So not only are some countries doing better than others, but some parts of the economy are doing better than others. So it's no surprise that face-to-face kind of interactions, the service space, are doing really, really badly. I mean, obviously, you're not going to restaurants like you used to. You're not getting onto airplanes like you used to. You're not going to movies like you used to. But people are still buying things. And if you look at, for example, in the US, real durables, personal consumption expenditures have rocketed higher. So these are big ticket items like washing machines and toaster ovens and those sorts of things, televisions, absolutely soared. So people have been spending quite a lot of money on stuff. And the bigger, the better. You know, they're buying this stuff so that they can put it into their new homes. New home sales in the US have absolutely soared and are at levels that we haven't seen since prior to the Great Recession back in 2008, 2009. Auto sales are right back to where we were prior to the pandemic. They really haven't blinked. This is all part of people moving out of city centers into more isolated or rural areas. This is people buying cars so that they don't have to drive, take public transportation. But it's also about people deploying the money that they do have, the income that they do have, away from the service space and into the good space. And this has really been a driver for some of our investment themes. So, for example, we really like materials. Raw materials are one of the areas where we focused our investment activity. And that's because the raw materials go into the stuff that people are still buying. Now, there's a third component to this K-shaped recovery, which is some people in the economy are doing much, much better than other people. So if you think about the jobless market as a whole, we're still running at a pace of unemployment, of jobless claims in the US, to take them as an example, that are around 3 times the 2010 to 2019 average. So the average pace of unemployment claims, if you include the special pandemic claims, relative to the average over the last years, it's running at a threefold, 3 times that pace. And we're actually still 1.5 times the 2009 recessionary peak. So the job market has stabilized, but it's stabilized at a very unpleasantly high level. Now, it's a very bifurcated market. So unemployment for people who are at the upper echelon, so we're talking about managers and highly paid professionals, that unemployment rate, it did spike, but it's come down quite sharply, and we're actually now below the 2009 peak. So unemployment for the more highly paid parts of the economy, we're talking about people for whom it's a lot easier to work from home for the most part, that is already back into recovery levels. But if you're looking at the unemployment rate for the services sector, which is the blue line on the right, absolutely skyrocketed at the depths of this spring during the recession, and it has recovered, but it's recovered to a level which is still well above, about 2 percentage points above what we saw in the peak of the 2009 recession. So you can really see this bifurcation in the economy, in sort of who's doing okay. Well, those tend to be people in managerial positions. Those tend to be people who can, do video conferences from their home and don't struggle as much with the face-to-face economy, as opposed to those who really do. The people who drive the taxi or who work in the restaurant, they're simply unemployed. So some people are employed and some people are not. Those people who are employed are spending their money on big ticket durable goods, houses, cars, stuff that you can touch, that requires material inputs. And there's a real differentiation between what countries are doing well and what countries aren't. So for example, China has recovered quite smartly. And again, that's a key part of our investment theme. We think China in particular, but also China-linked emerging markets are going to do reasonably well in the coming 12 months. So having gone through very quickly sort of a view of the economic world and the recent return of lockdowns in Europe. Now what I'd like to do is spend a very few minutes trying to unravel what's going on in the US with the political situation. I apologize for this slide. There's a lot of words, and I won't try to read them all, but I'm trying to give you, our friends and our clients, a sense as to what I see happening over there at the moment. So the US political system, the electoral structure, is anachronistic, to say the least. Most people who aren't Americans don't fully appreciate how complex it can be, and even most Americans, I think, don't either. So the election happened last Tuesday, and votes are still being tabulated. A lot of those votes are mail-in ballots. I voted mail-in, for example. That is perfectly normal, and it does take time for those ballots to be counted. Now, each of the 50 states has their own rules as to how votes are counted, when they can be delivered, or when they can start being counted, et cetera, and so forth. And that's a big part of why we've had such a differentiation between those states that have already counted all their ballots and have announced the victor versus those which still have yet to. So as we speak, there are 5 states which are in close contention: Arizona, Georgia, Michigan, Nevada, Wisconsin, and in fact also Pennsylvania. Now, Pennsylvania, as we sat down, actually has now started to lean for Biden. And with Pennsylvania, Georgia, Arizona, Michigan, Nevada, it now looks like Joseph Biden is going to be the president. That's not a done deal, and it won't be a done deal for a few weeks. The first thing that has to happen is that these votes need to be officially finalized. There are already a number of recounts that have been requested, and lawsuits have already been launched by the Republicans, questioning the validity of many of these ballots. Now, I don't think that the recounts will ultimately change the ballot results. They rarely do. I also don't think that the lawsuits will prove to be successful in overturning the result, although I'm less certain about that. There are more paths there. But it does look like what we're going to see is a Biden presidency with a very narrow margin. Now, the markets initially reacted to the voting results that showed Biden having a lead by unwinding much of the blue sweep positioning that they had put on before the election. And that's because whilst Biden was taking a lead, he wasn't taking anywhere near the kind of lead that the market expected. And that pointed to the possibility that the Democrats would not take the Senate. So as we stand, the Democrats have retained a majority in the House of Representatives, but it's a smaller majority. And the Republicans have retained a majority in the Senate, but it's a smaller Senate. So what I think the market is trading right now is a Biden presidency and a divided Congress. So what does that mean? On the fiscal stimulus side, it means that it's likely to be much smaller than would have been the case if we had the blue wave or the blue sweep that the market was trading just a week ago. Now, I want to be careful. I still think a fiscal stimulus is coming. If not by the end of this year, then almost certainly in January. We're just not talking about quite the same size. President Biden with a divided Congress probably doesn't allow for any dramatic reversal of the Trump tax cuts. I think tax cuts are eventually going to happen, maybe in the next 12 months, certainly in the next several years, simply because of the debt burden that the U.S. government faces. But with a divided Congress, I think it's going to be a much tougher sell. I think that the trade relationship with China is still going to be very, very fraught. This is one of the issues that both sides agree upon. But I do think that a Biden presidency would make some strides to try and rebuild its trading relationship with other partners, Europe, Japan, etc. I think that on the regulatory front, a President Biden would probably reverse a lot of the executive orders that were put out by President Trump, but fresh legislation is probably not in the cards. I'm not sure that makes a huge amount of difference at the moment, because the existing legislation that's on the book gives the president quite a lot of leeway. On the pandemic, I think that a President Biden would probably pursue a more active public health approach than President Trump did. I want to emphasize that in the U.S., public health is for the most part a state and local activity. So the federal government can step in with money and support on the boundaries. But at the end of the day, each state is going to have its own lockdown policy, its own procedure. And then finally, on the healthcare side, so I know that this has gotten a lot of attention. I think that with the President Biden, regardless of what happens in Congress, you're going to have existing Obamacare legislation reinforced. But I think you're also going to see drug companies come under pressure pharmaceutical companies come under pressure because of drug prices. So what does this mean for the markets? Growth stocks rallied hard this past few days as the repeal of the Trump tax cuts no longer looks like an issue. The same thing with tech stocks also have rallied quite a bit. Healthcare stocks look a bit more healthy, so to speak, as well. With less of an expectation for a large fiscal stimulus, I think that treasuries have reversed, and we've seen yields come back down. So that's taken a little bit of that's been a bit of a support for the markets as well. And then finally, with rates coming off, as people are less worried about the funding requirements, that's pointed to a modestly weaker dollar. Now, I'm just going to leave you with one observation, well, two actually. The first is that nothing is done. There are a lot of things which could change this political outcome. So, for example, we could still have a blue wave. The 2 Georgia senator seats are coming up for a runoff election in January. It's unlikely, but they might actually both go Democrat. That would give the Democrats control. There are a lot of permutations to this electoral count, which could leave either Trump in power or put the vote into the House of Representatives. The second thing is, even with a divided Congress and even with a President Biden, there's still the potential for trade negotiations to result in packages and deals coming out of the Congress that would result in sort of surprising outcomes for the market. So I think that at the moment, it really behooves to remain cautious and to avoid putting on any aggressive trades that are the U.S. election. So with that, I'm going to hand it up to any questions that we might have. And if there are none, then I will hand it over to my colleague, Adrian.
Thank you, James. What can I say about fixed income? It's becoming a very difficult environment to really make any kind of returns going forward. So as we've been talking about, there's always been this hunt for yield, but it's become even more exacerbated with the low rate environment, which looks to persist going in the next couple of years. So we have to be a lot more flexible in our approach towards fixed income. And I'm going to go and talk to you about how we look at fixed income and how we actually discover where we want to position ourselves within this environment. James, if we can move to the next slide, please.
Is this not the slide you need, Adrian?
Yeah, this is the slide I mean, yes, please. So here we can see how the US fixed income market overall actually looks at if we create the par curves for the various different types of bonds. Like at the bottom, we have the US government bonds, and above that, we have the different corporate bonds by their rating categories. And you can see at the short end of the curve, even going down towards the single A's, you're not getting any significant yields. So that's why on the short end, we actually prefer to be holding triple B's and high yield bonds, where we feel that there's sufficient liquidity in these companies to offset any potential risk. Where we extend duration, we start moving more into the triple B's, double B's at the actual 7 to 10 year part of the curve, which is still pretty flat on the treasury side. And towards the long end, we consider some of the high rated bonds, some of the treasuries, just to give ourselves some protection. So we actually look at making a mix of the entire fixed income just to try to give us some sort of yield. So if we look at it, we are actually having to shift not only our credit risk spectrum, our tolerance for what kind of credit risk we want to take, but also the duration overall. So within that, we've able to just, for example, create a portfolio of treasuries, which have to be 30 years, double rated bonds, triple B rated and double B rated bonds, and we get a potential yield of 1.75% per annum. It's not great, but it's really the most we can do and better than any sort of index going forward. One thing I'd like to add here is, as James sort of mentioned, we are now starting to also start looking at other economies like China, which also issues some US dollar bonds going forward as well. So we may have to shift our tolerance to adding more emerging market related risk, although there's debates whether China really should be seen as an emerging market. One other thing I'd like to say is that what James has said is about the election, I totally agree with, and we have to trade treasuries within this. So, for example, for me, in my mind, in this quarter, I expect treasuries to, as we get towards the end of the year, trading range between 80 basis points to 100 basis points. But if I do see any treasuries start to come down to around 60 basis points, I'll be looking on the 10-year, I'll be looking to sell those treasuries and just wait for it to widen out again and keep on repeating this process. Now, if we move on to Europe, what can I say, is a negative yielding market. There's really not much you can buy out there which is offering any kind of positive yield. The UK, unfortunately, is also going to be heading this way. So within Europe, we've always stuck with the periphery bonds. We know these bonds are underpinned by the ECB with asset purchase programs, so we've been comfortable holding them, holding things like the Italian 10 years to Greek 10 years. But now I'm starting to question how much further can these really go? Are they going to go to negative yield? It feels a bit strange to me to be holding these kind of economies, which are healthy with high debt to GDP levels on negative yield. So we're starting to now look at, as I said, China. Which country would I first be holding? Chinese sovereign bond or an Italian government bond? The difference in their 10-year paper is roughly, I think, as of today, it's about 10 basis points actually. So China is much higher rated. I'm going to be looking to switch over into China at some stage. This is what we have to do. We have to start increasing our tolerance for risk going into other sovereigns, other credits, maybe in the emerging market more than we have in the past. If we move on to the other option that we have, and this is something which I sort of strongly advocate, it's a little bit more complicated to do, but most portfolios have a currency which they're mandated in. So if you're a dollar portfolio, you really are looking into buy dollar bonds. However, when you actually hedge the currency risk, everything out, and buy a bond, for example, a Japan 10-year bond yields 1.3% when we strip out all the currency risks and hedge it for that period of time. This means I'm getting, a 60 basis points almost pickup over the United States bond. Japan, US, I've got no real difference. And in fact, Japan has lower volatility on the bond market currently than the US, because we know that the Japanese government has yield curve control on their bonds. They won't let the Japanese 10-year bonds go wider than 10 basis points. So we keep an eye on this, look to trade around this as well. And this is something I seriously recommend that people do. Look to buy local currency bonds in other, in your portfolios, hedge out the currency risk and hold that for the yield. If we move on, within the, sorry, can we go back one, please, James? So, sorry, to the home builders page. So within the credit markets, we actually look at things like which sectors do we like. So taking the cue from what James has been saying about where he sees the economy recovering, what's happening there. For example, we see US home builders has an important part of our portfolio. So 30-year mortgage rates are making homes affordable to people. People also moving away from the actual inner cities up into the suburbs and outer areas. People are looking to buy. So within this, we've looked at it and found that the home builders actually are fair value. If we look at them historically over a long-term cycle, it actually fits into our profile. Looking a bit deeper, we can see we can buy short-dated bonds, triple B rated bonds, as I said, if you remember my chart on the US curve, at roughly 1%. So we look to try to pick some of those up, and then we look to buy some double B rated names or so on, which are yielding 3.5%, 4% at the long end in the 26, 27s areas as well. The other sector, which we also like, is the auto sector. Once again, autos, they had a production shutdown due to the lockdown. Now they've had people looking to buy these big ticket items like the houses, cars. Due to this, we've seen actually the autos starting to have very reduced inventory. They offer attractive yields once more. So once again, they are also cheap to the overall, fair value overall to the actual high yield market overall. So this is another sector we like. And once again, you can see how by, for example, buying Ford short-dated bonds, GM short-dated bonds, and remember, these companies are being supported by the Fed as well. We actually can pick up yield not only by the short end, which fits our liquidity bucket as well, but also towards the 7-10 year, which is our sweet spot as well. And we're earning roughly 3 to 4% yields, ideally. So with that, I hope I've given you an idea of how you would start looking at fixed income. It's become a relative value game. You have to drill down into sectors, into various different segments of the curve. You have to be willing to switch your currency of the bonds and hedge your currency risk within it to really make any kind of return going forward. And this is a strategy which I think will be with us, unfortunately, for a next couple of years at least. We can't just buy and hold because the yield is not sufficient these days. If anyone has any questions, I'll take them here, or else I'll pass over to my equity colleagues.
Fantastic. Thank you very much, Adrian. So we're going to hand it over now to Mikhail. And again, if there are any questions, we're also happy to take them at the end of the presentation.
Good afternoon. Thank you. Thank you, colleagues. So let me start by highlighting 3 key messages for equity section. So first, although Q3 earnings season has been better than feared, earnings demonstrated substantial decline. Second, we saw that new lockdowns in Europe and implemented, and we thinking that our investment themes, particularly video games and online life, might get additional boost as a result of this. And finally, speaking about emerging markets consumer, we're thinking that Chinese e-commerce and cloud remain 2 growth pillars for this topic. Let me start by highlighting our performance for October. And our portfolio holdings managed to outperform the MSCI World by around 1%. And this brought our year-to-date performance to 18.4% versus MSCI World being negative 1% as of end of October. So for our portfolios, we did several meaningful changes, and now we're staying around 2/3 invested out of our neutral equity allocation. So for core part, we scaled up existing holdings in ETFs, which are tracking global materials, and also we added ETFs which are tracking international or ex-US stocks. Also ETFs which are tracking global value stocks and small cap stocks. On satellite side, we sold 1/3 of our holdings in Unilever and we used recent sell-off, recent stock weakness to buy stocks of Ubisoft. Moving further to earnings season, it's almost finished now. We've seen from one hand that company reported better than expected and managed to beat estimations by 20%, while from the other hand, the actual earnings demonstrated quite substantial contraction with around 8% decline for the S&P 500. Speaking about our portfolio holdings, so far they've been reported better than expected, and the largest surprises were coming from EA, Ubisoft, Amazon, and Alibaba. So we have several stocks which yet to report. On this, let me provide you update with regards to our thematic investment ideas, and let me start with video games. And basically, video gaming activities has shot up across the globe as lockdowns were introduced in March, and after the lockdowns were gradually lifted, the activity has started to moderate. And you can see this on the left-hand chart. So you can see that this video gaming activity measured by the total number of players on Steam, which is the major PC gaming platform. Also not surprisingly that the activity has shown very strong correlation with the Oxford Stringency Index. So this index actually supposed to track government measures in response to the COVID-19 pandemic. But you can see that actually the level of activity started to recover since August, and now as new lockdowns implemented in Europe, we can expect that this elevated level of video gaming activity will persist at least till the year end. And finally, in addition, Q4 usually busiest period of the year, and new iterations of existing franchises and new titles ordinarily coming to the market. Speaking about our top picks, so we do like Ubisoft, and you can see this on the right-hand chart that these stocks actually cheaper than AAA producers, other AAA producers, and also grows much better. And we used recent sell-off in stocks 1 week ago as market seems was focusing on fact that the company postponed several titles, but at the same time we find very promising that actually the company reiterated the guidance, and now this guidance is supposed to be met by fewer number of titles, which actually reflection of strong video gaming activity. Okay, so moving further to the next, our investment theme. So let me speak about online live, and another heavily impacted industry is actually cafes and restaurants. And after free fall in reservation, you can see this on the left-hand chart in March, and activity started obviously to recover once lockdown was removed, and actually the line you can see it peaked in September, and now reservations remained at around 4% below the pre-pandemic levels, and actually it is despite the fact that almost 80% of the restaurants still were reopened. And now with new lockdowns, we hardly can expect any first improvements, and this gave a rise and strong tailwind for food delivery services. According to surveys conducted by Goldman and by Morgan Stanley, in the US and in Europe, we can see that frequency of orders gone up, and also share of respondents ordering food at least several times per month increased substantially. So speaking about particular stocks, we do like Just Eat Takeaway. The company reported a very strong Q3 update, and the number of orders actually accelerated and reached more than 150 million orders per quarter. And it one more time reiterates the strong demand for food delivery. And also what we do like in this company is that the company managed to expand into key countries, and now is the process of acquisition GrabHub, which is key for the US market. Moving further to the last theme, which I want to give update. So emerging market consumer, so two growth pillars, Chinese retail sales and online shopping first. So, and we've seen that frequency spending and penetration in China was rising, and actually very consistent nationwide. It also consistent across tier 1, 2, or 3 cities. And as a result of this, online share of total consumption expanded. So speaking about online shopping platforms, Taobao, Tmall, which belongs to Alibaba, and JD.com were consistently the most popular in China. So recent survey just demonstrated that 99% of respondents, they are using Tmall or Taobao, and this was followed by 89% of respondents which saying that they were using JD. And finally, let me share a couple of thoughts about Chinese cloud market. And we see this as a growth pillar for Alibaba and Tencent. So China cloud demand accelerated because of businesses' increased investment in cloud. It allows them to keep up with the jump in consumer online activity, as well to improve overall efficiency of the business. And cloud migration actually also supported by the Chinese government. And in this way, Chinese government actually trying to support small and medium enterprises. Yeah, on this, I think that I'm gonna move to question section.
Great, thank you very much, Mikhail. If we don't have any questions, then I will move it over to Annie.
Hello, thanks, James. I'm back for some more updates on the ESG sectors. So on the previous, in the previous sections, I shared some recent market trends about ESG and impact investments. Today, I actually would like to share more some details about the practical implementation of the ESG integration process. Be conscious about the time, I'll be quite brief about it. I won't go into detail, so if you have any questions, please feel free to send me emails you want to know more about it. Looking at the, actually talking about the elections, with Biden potentially becoming president is actually good for environmental policies in America, because it means America will join recently China and Japan, the list of countries who are aiming at neutral carbon emission by 2050. So the organization called Global Sustainable Investment Alliances publishes a report that gathers all the important findings in the markets. on a biannual basis on the major markets like Europe, US, Canada, Japan, and Australia and New Zealand. So here I've picked the growth information about different markets to show you how the markets in general across the major countries have been growing quite dramatically, especially on the social and environmental impact investment side. Of course, ESG and negative screening has been made the main strategies for some times now, because they're focusing on the public spaces which are more liquid, but because of also the current pandemic situation, the impact and community investing, which are investment with a social and environmental purpose, are growing quite quickly. And the ESG integration, it will be actually the approach that the Dolfin is aiming to adopt. So generally, negative screening is the very first approach that all the asset managers adopt, but it wouldn't be the only approach because it simply screens out the companies that are viewed negative on ESG perspective. But normally, it's used in conjunction with different approaches to make the whole framework more comprehensive. So the negative screening approach, as I've just mentioned, is based on exclusion. Versus ESG integration is actually incorporating ESG factors throughout the investment process. And they'll be analyzed alongside all the key growth elements of the companies. If we flip to the next one. So here, the slides are showing the different phases of the investment process, starting from the very first step, which is, of course, defining the investment objectives of the investors, and define a policy. From a company's perspective, of course, it's important to define a ESG policy and the framework. At Dolfin's level means coming out with a policy framework which are consistent with the Dolfin offering and the traditional discretionary investment process. Which also means as a manager will have the discretionary responsibility and expect to incorporate ESG values and factors throughout all different stages. The second stage, which is the most complex one, is the portfolio construction. During the portfolio construction, we do both a qualitative analysis and quantitative analysis, where we analyze, we incorporate the ESG factors actually into the company's valuations. And then after valuation, through utilizing different techniques, we can understand if a company is undervalued or overvalued compared to the competitors. Of course, again, this will be used in conjunction with other approaches, which means we'll have a sort of a minimum standard to include the companies inside the portfolio. And among all different techniques, we adopt a fundamental strategy. And then once the portfolio is constructed, then of course, throughout the investment period, we'll monitor and manage the ESG risks accordingly. And then on the quarterly or annual basis, we'll issue the report, which shows investors the different ESG matrices. If we go to the next slide, here you can actually see the different analysis that will be carried out through the fundamental analysis. So I won't go into details. Again, like if you have any questions, please feel free to email me. But so we will go basically from macro level to company level, which is quite similar to the traditional investment fundamental approach. It's just at every single analysis, we also incorporate the ESG factors to come up with a more comprehensive investment decision. And with that, I've concluded my section. And thank you everyone for joining the webinar. Please let us know if there are any questions.
If not, I'll take over, Annie. Thank you very much. Just a couple of points from my side. The recording will be available and will be sent out to everyone that has attended, as will the slide decks, which is going to be published as part of our sort of monthly slides going forward. We were talking a little bit before the presentation, saying we've been trying to come up with as many insightful and interesting new ways of looking at the current environment. As we do head into 2020, one of the things that we have been, I think, struggling with for the last 3 or 4 months is this sort of concept of portfolio construction and the new normal investment environment that we're operating within. As Adrian was saying, it's getting harder and harder from his perspective to identify interesting opportunities within the treasury space and along the curve, and for Jeff on the credit side, trying to identify companies that have these sort of COVID-19 compliant business models that we've been increasingly investing into onto the equity side. Investment strategy is always going to change and evolve over time. I think we've had an accelerated change of both our sort of habits and abilities as consumers, and this has had to factor much quicker into our investment portfolios and adoption of our investment strategy. 2021 is definitely going to be a year of stock selection, sector selection, and timing, as we're going to be looking to move into and out of different opportunities and ideas. This is going to obviously be linked in with what's happening with COVID-19, the economic underlying environment, and consumers, as James highlighted a little bit, and Mikhail followed up on that in terms of our big focus for 2021 and beyond is going to be emerging market consumers and looking at a lot of the different ways that we are able to play that, and not necessarily with emerging market companies. Thank you all for attending this afternoon. Appreciate we are a little bit later in the week than normal. If there are any questions that you have, please feel free to contact your relationship manager directly, and they can follow up with us. Yeah, otherwise, all it remains for me to say is thank you very much and enjoy the rest of your Friday and the weekend. Goodbye.